how to start investing in real estate in 2024 on an average salary. All right, guys, let's talk about this. I've got 3 ways we're gonna talk about investing in real estate with an average salary in 2024. But the first thing I wanna do is get everybody on the same page. What's an average salary? So let's just jump over here and do Google. Actually, I'm already on Google. What is the average salary in the United States? Or actually, let's do household income. What is the average household income in the United States? So, depending, United States average household income is $107,000. Okay, so let's make a quick note of that. So household income is $107,000, okay? Then let's just say, what is the average salary? So Q4 2024, the average salary was $60,000. For an individual. So when you say average, these are the numbers that I'm thinking about. I just pulled that up, but this gets us a good start as to what we're talking about. So the first thing I want to talk about here is this concept of house hacking. Okay, this is the concept. The concept is you buy a house, you live in the house, you fix up the house, and then you sell the house 2 years later. And then you go back and buy another house. The interesting thing about this is if you've lived in a house at current IRS 2 out of the last 5 years, there is 0 tax on that. So let me show you. Okay, so this is the IRS's website. So let's make sure we're on the right place. In general, okay. If you have capital gains from the sale of your main home, which is your primary residency, you may qualify up to $250,000 of that gain or up to $500,000 of the gain, joint filing returns with a spouse, okay? And then this gives you some more details on that. Obviously, you're gonna wanna check with your tax accountant and those types of things. But I can tell you from my personal experience, you can, if you're married or if you're individual, you can go up to $250,000, you pay 0 tax on it, or you can go up to $500,000 and pay 0 tax for a joint filing, married filing joint, or this is individual. So think about this. If you buy a good deal, live in the house, fix the property up, and you sell that property and you make, I don't know, $50,000, $100,000. I don't know. It depends on how good of a deal you buy it for. It depends on what fix-ups you do. It depends on when you sell that property. But on average, let's just jump back over here and look at some averages here. One of the interesting, it's 2 out of 5 years, so you could actually rent the property for 3 more years if you wanted to. You just have to live in that, of those 5 years, you've got to live there for 2. So typically, you could live there for 2, you could rent it for 2, or you could just sell it right after. But let's just take, I don't know, any time frame and look at the percentage increase from, 2010, I don't know which one to use here, 2010, 2009, and let's say you sold it in 2011. So it went from 208, in value up to 238, let's call it. Not a ton of appreciation on that, $30,000, but if you bought a good deal, like you bought an off-market property and you added value to it, like you finished the basement, maybe you see another $50,000 on that, so you have $80,000. The great thing about this is you're not paying any tax on this $80,000, so then you could use this $80,000 to put on a down payment on a rental property. Which I'm going to talk more about here in a minute when we start talking about rental properties, but this is part of the house hacking. Another way that you can house hack is, let's get rid of this real quick. This is house hack 2. This is what I did. Okay, so you can buy a house, or you can buy a duplex, or a threeplex, or a fourplex. You can get an FHA owner-occupied loan. So with this, you're only putting like 3.5% down. And what you do is you buy a good deal and then you rent it out. Now, a lot of people are doing this with mother-in-law apartments. So they buy a house and then they turn the basement, or it already is something they can actually rent out. Now, there's some zoning laws and you've got to make sure that you're approved to do that, but renting out the basement. And then the rent from that basement, maybe it rents for $2,000 a month, and maybe your mortgage payment is $3,000 a month. Well, guess what? You've got a nice house with a nice yard and everything else, and you're living there for less than what a mortgage payment would be on this house, because it's being subsidized by the people who rent the basement or rent the upstairs, right? So that creates some additional value, because if you're traditionally going to be paying $3,000 a month and you're only paying $1,000 a month, you're making $24,000 extra that you can then take that and go reinvest somewhere. You can do this and sell that if you've lived there for 2 out of 5 years and make the appreciation, or you could rent out both of those potentially. What I did is I bought a duplex, I turned it into a threeplex, and I had the 2 tenants pay the majority of my mortgage payment, which also with that, they were paying down my principal that was owed, and I lived there for little to nothing. But the money I was going to be spending on rent, I then took that and invested that money. So this is house hack number 2, which is putting another dwelling within the property and getting other people to pay that. So you have reduced rent or reduced mortgage payments based upon somebody else doing that. So that's house hack number 2. So house hacking is the first way I'm going to say to do that. This is something anybody can do. You need 3.5% down. You will have to have decent credit because you are getting an FHA loan. So you want to make sure there's no judgments or collections or charge-offs and those things. So let's say you do have some of those things, so judgments, collections, charge-offs, that type of stuff. Then what do you do? Okay, so there's something you can do, whether you have those or don't have those. This is something that you can actually do, and this is actually called land flipping. Okay, a lot of people don't know about this. This is a very underutilized strategy, but the concept here with land flipping is property that's unimproved. It might have, or I should say, property that is not built upon is hard to sell. It's also hard to get loans on. Most lenders, if you own this piece of land, aren't going to come and say, we'll give you money on this. Typically, a lender's going to say, you put up the land, we'll put up the construction costs, and then we'll build on the property, but you're putting up the land. So if somebody owns a piece of land and they need to get money, they need to liquidate in a fast manner, it typically is going to take them 6 to 12 months to get money. Well, what if they're going through a divorce? What if they've got a family situation? What if there's a medical situation? What if they just need the money fast? How do they get money fast? Well, one of the things they do is we say, hey, we'll give you money today, but then we'll take on the risk and sell this, but we're going to do that at a discount, okay? So what you're doing is you're actually buying a piece of land from somebody that's a motivated seller that needs the money quickly, and then you're taking on the risk, marking that price up and selling it in 6 to 12 months, and that's land flipping. So that's something anybody can do regardless of your personal circumstances with the way that we actually fund those deals. So that's something anybody can do, even if you don't have great credit, where the first strategy, you've got to have decent credit. Now, I hope if you do these land flips, you'll use that money to actually improve your credit, so then you can actually go buy those houses, or as we move into number 3, which is rental properties. So way number 3, I would do this in 2024, is through rental properties. What a lot of people don't realize is what are called DSCR loans, okay? This is debt service coverage ratio. And basically what that means is there's a percentage, let's just call it 1.2, which means if your mortgage payment's $1,000, they want to make sure that your rent's at least $1,200. And then they're not worrying about credit and background and all those types of things. They just want to make sure you don't have judgments and collections. But if that works out and that matches and the property has the value, maybe they want 85%, maybe 80% loan to value. If they have those things, then you can get that loan, and it's pretty easy to get. It's not like getting a traditional loan. So with this, you either need to have that $20,000. If it's a $100,000 purchase, 20% loan to value, you need to have that $20,000. If you don't have, now you could get that $20,000 by not having to pay your full mortgage payment because somebody in the basement is paying for that. You could get that money by buying a house and then selling it 2 years later and getting appreciation gain. Or you can combine this with one of my favorite strategies, which is called BRRRR, okay? And what you do with that is you buy the property, you renovate the property, you rent the property, and then you refinance the property. And so we would be refinancing the property with this DSCR loan, but we would be buying the property using a hard money loan. And that hard money loan would allow us to buy a property that's not in great condition and would also give us the money to actually do the repairs on the property. So now I have the money to do the repairs. So if I get a good deal and I improve the value of the property by doing all these repairs, I then rent the property, I have created some equity. So if I get a good enough deal, I may be able to get my purchase, my rehab, my closing costs, and my payments for the first 5 months all included in that loan. Typically, as long as all that's under 74% of the after repaired value, not the as-is value, the after repaired value, then I could get all that included. And if that's the case, when I rent the property, as long as I'm renting it for that debt service coverage ratio, then when I go to refinance the property, I'm already gonna have equity because I'm gonna have 74% and they need 80%, which means I'm coming into this deal with little to no money into this deal. I'm doing the BRRRR method, I'm refinancing into a DSCR loan, and then I'm keeping this property as a rental property long term. Now you're gonna say, well, why do I want to keep a property long term? Well, a few reasons. One, there is appreciation, right? So you can see here about every 10 years, you're seeing property values go up 30 to 70% about every single 10 years. The other thing that you've got to keep in consideration is rents go up. They just do. If you look what's happened with rents over time, it's drastic. And one of the things I like to point out is 2008. When 2008 happened, rents went up. You don't see this big downward like you do with prices. And frankly, it's kind of interesting here because if you look, there's 2008. So if you look at the high, 257, and it went down to 208. So what are we talking? 20, not even 20, 15% decrease in value. And then you can see it's just gone up from there. So everything with real estate is just holding time, right? If you bought here, in 2017, in 2012, you were back. So 5 years later, if you bought at the peak, 5 years later, it was worth what you paid for it. So as long as you have the holding power to keep you between there. But then you can see if you bought here and then you sold up here, you've almost doubled your money. And that's from 2006 to 2020. So what is that? 16 years later. So it's all about having this staying power. But the most important thing you can do in 2024, if you have an average salary, is to get started now. Usually what happens is people put it off and they don't take action. And lack of action will have more of a detriment in your long-term financial future than doing something and making a mistake. Most people are so afraid of making mistakes they don't even try, but nothing ventured, nothing gained. You've got to take some action. And as long as you have the staying power in the long-term, real estate always goes up. At least it has for the last since 1960, and we started measuring this stuff. I hope this is helpful in how you can get started in real estate investing in 2024 on an average salary.